Hi folks, and welcome back to this final video on question 5. In this case, what we're doing is we're assuming now that Foxx, instead of using the cost method to record its investment, recorded it on the equity basis. We remember from our earlier studies in this course that whenever you're recording on the equity basis, there is a value for the investment on Foxx's, or the parent, in this case Foxx's balance sheet, separate entity, which is going to be different from the cost. The original cost of this investment was $117,000. So we would expect that we're going to get a value for the investment in the sub-account, or investment in Rabb, which is the sub-account, for it to be a value that is different from $117,000. So let's begin that calculation. You remember when we did question 4, we said there were two different ways to do it. The first way you can do it is to start with the non-controlling interest at December 31st. And the reason I'm doing it December 31st is because that's the date at which we want to calculate the value of the investment in Rabb account on the balance sheet of Foxx. So don't forget what NCI represents. It represents 25% of the investment, because don't forget the NCI shareholders are picking up their portion of the investment, right? So the idea here is that 25% of that investment would be equal to NCI share. So if I took the NCI's 25% share of that investment, which is $51,500, I calculated that earlier, and divided it by 25%, I should get what 100% of the investment is, right? So if I took $51,500 and divided it by 0.25, I would get $206,000. I'll just put that in here. Now, if I multiplied that by 75%, right? If I multiplied that now by 75%, if that's 100%, then 75% would be the actual value of the investment account on Foxx's separate entity balance sheet under the equity method. So that's one way of doing it. I like this method the best because it's easier and you can use numbers you've already calculated. If you're not confident in your calculation of NCI, don't feel like you can't use this method. At least if you use a method that's correct and you follow through with your error correctly, you will lose very, very minimum marks. So I would encourage you, to pick the easiest way possible. Now, let's say you didn't remember that method and you said, gee, I know the investment when I bought my shares in Rabb, and the value of the investment was $117,000. You can start that way too. So the investment would have increased or changed as a result of any retained earnings that Rabb earned since the day you became related. So it's only that equity that you're picking up after the two companies became related, and you're picking it up at your share. Well, one number that can help you figure out what that is the retained earnings balance that you calculated. Okay, the post-acquisition adjusted retained earnings balance for Rabb, the sub, at December 31st, year 6. So let's go back and pick that up, because we did it back in Part F, right? Don't forget, in Part F, you can go down here, because you're looking to calculate the investment account at that December 31st, year 6 date. So the question is, how much equity did you pick up in that sub? Because that's going to represent your share of the investment in that sub. So don't forget, if the retained earnings of Rabb was sitting at $120,000, $30,000 of it was acquisition and we wanted post-acquisition, from that $90,000 difference, we're going to deduct the cumulative acquisition differential amortizations and any impairment losses cumulatively, which only happened to happen in year 6. So we're going to pick up our share of that $50,000. So that $37,500 not only affects your ending balance of consolidated retained earnings, but it's also used to help you calculate the value of the investment account. So when we add it to the original cost, we're going to get $154,500, which is exactly what we got under this first method. So those are two ways you can do it. Now, the only problem I tend to find with students if they're doing the second way is they don't really understand what they're calculating here. Well, that's a problem we would have come across in Part F. But just to summarize, don't forget, the value of the investment in Rabb that Foxx holds, Foxx is really entitled to getting its share of all of the equity earned by Rabb, the sub, after they become related. Well, all the equity that Rob's earned is sitting in its retained earnings because that's where consolidated income gets closed out. Just like if you had a company and you were doing your books, you'd have to close all your income statement accounts to retained earnings. So it's consolidated entity does the same thing too. But the idea is all that income gets closed out. So I want to know, what's that post-acquisition income? Or in other words, it's all accumulating in retained earnings, right? So that's why I go back to retained earnings. I'm saying, well, all the equity that I earned in that sub from the date we became related, if they earn $50,000 in total, don't forget it's adjusted for the cumulative acquisition differential amortizations and the impairment losses. That adjusted value, my share is 75%. So that's additional equity I'm picking up, right? And it's going to be reflected in not only the consolidated retained earnings, but also in the investment in the sub account. So this concludes our calculation of the investment in Rabb account if Foxx had used the equity method. I hope you found this helpful.